officers.
Well, you know, it's kind of incredible. We had a guest named Steve Blumenthal booked. Steve, are you there? You with us from CMG Capital?
Yes, I am.
The last time you were with us, there was also a White House shooting. It's very coincidental. But as you look at this, there is no reaction. In fact, the markets are now climbing higher. The Dow was up 47 at the moment, now up 57, perhaps because, you know, and I don't know, you tell me if the markets react to these things now that the man with the gun has been shot and at least neutralized for the moment in the hospital in critical condition.
Yeah, I think that they tend to, and they react initially, and then, of course, there's a lot more comfort now. I would suggest to the White House that perhaps that they check my schedule with you. It seems to be a pretty good indicator as when something might strike up.
Well, I think the markets are getting immune to this sort of stuff. I mean, obviously, this is different. A crazy guy with a gun, you know, please take appropriate action. It's different than a real terrorist attack, but you know, we didn't see much market movement on the San Bernardino thing, and I'm not saying, like, listen, we should reduce this all to market movements in our hierarchy of what is important, what is news, business news. But you know, just for the average investor, it's kind of clear that the markets, which used to trade off of terrorism a lot, they don't. It's kind of we're becoming inured to all this. It used to be considered like a massive economic event, i.e. 9/11 was, but stuff is done so much electronically now that
Steve, Steve, when you look at these headlines, and what is your advice to investors? Ignore them. You know, everything from perhaps the Egyptair crash or perhaps attacks on oil pipelines. We're looking at the markets getting closer and closer, but the Dow does not look like it will win for the week. Steve?
Boy, if we look at it short term, that doesn't make any sense. Investors should ignore this type of information.
Mm-hmm. And ignore, too, that you're saying that you expect a recession. We've gotten some pretty decent data at the moment. I won't say healthy and robust, but decent.
If you look at the last decade, we had 2 recessions. In the 1990s, we had a recession. In the 1980s, there were 2. In the 1970s, there was 1. In the 60s, there were 2. We get recessions every decade, 1 to 2 each decade. Yeah. We're very aged in this cycle. You see corporate earnings slowing down significantly, 4 quarters in a row of decline. Debt is our biggest issue. It takes more and more debt to drive $1 of GDP. So recessions happen. They're healthy. We're going to have them. And the reason we need to be aware of recessions are that equity markets decline 30 to 60% in recession.
Yeah, you know, Charlie, again, we got existing home sales data that surprised to the upside, an upward revision. Right. Next week, by the way, we're getting a revision on GDP. Could be positive.
Yeah, I know. I get the 7-year itch thing with recessions. But one thing I would say is that we've had such slow growth for the last 7 years that there is a theory that, well, that changes the tune, you know what I'm saying, a little bit.
Okay. Well, as we gear up for this closing bell for the week, the S&P and the NASDAQ have snapped the losing streaks. Up for the week. The Dow doesn't quite make it. Our thanks to Steve Blumenthal.